Hey, Ivan from the EV Stock channel here, and in this episode we're going to be visually looking at Tesla's Q4 numbers. But before we begin, thank you to all the Patreons that make these episodes possible, and as always, all content is my opinion only and not financial advice. So let's get straight into the numbers, starting with revenue, where Tesla reported a record $24.4 billion, which was up 37.4% from Q4 of 2021. However, when we look at Tesla Energy revenue, we can see that revenue doubled from Q4 of the previous year. And if we annualize the Q4 numbers, that already puts Tesla Energy at over $5 billion per year, and the growth is only expected to continue.
Energy storage also saw record growth, and that is continuing to accelerate. So we're obviously ramping up megapack production, and we expect it to grow at a rate quite a bit faster than our vehicle output.
When we look at services revenue, it's a similar story, with a record Q4 and an annualized $6.8 billion run rate. And also note, Zach gave us a great insight on Tesla Insurance, which makes up a big part of services revenue.
I'm happy to provide an update on where we stand in the business. So we're currently at a $300 million annual premium run rate as of the end of last year. We're growing 20% a quarter, so it's growing faster than the growth in our vehicle business. And in the states in which we're operating, on average, 17% of the customers in those states are using a Tesla insurance product. So, and that number continues to tick up as we spend more time in markets. And we see most of the adoption occurring when folks take delivery of a new car, as they're setting up insurance for the first time, as opposed to going back and switching when they already have insurance set up. So there's an inherent stickiness in the insurance business.
Finally, on revenue, let's have a look at Tesla's price-to-sales ratio, where the share price drop along with the revenue growth has combined to give Tesla a price-to-sales ratio of 4, which is quite a drop from previous quarters, and something interesting to observe, especially for those interested in financial ratios. Moving on to profit or net income, where Tesla reported a record $3.68 billion net profit. I mean, for all the noise out there, this is the most important chart and it's trending in the right direction. If we look at the price to earnings ratio, where I annualize the quarterly number and use the market cap of the final day of the quarter, Tesla's PE ratio dropped to 26.4. I mean, I don't think anyone would have thought that Tesla's PE ratio would drop this low, but it's a great lesson nevertheless. Now, let's have a look at some of the things that affect profit, starting with gross automotive margins that came in at 25.9% including credits. And Tesla did give us some guidance in regards to what to expect following the most recent price cuts.
So, there's certainly a lot of uncertainty about how the year will unfold, but I'll share what's in our current forecast for the moment. So, based upon these metrics here, we believe that we'll be above, both of the metrics that are stated in the question. So 20% automotive gross margin, excluding leases and red credits, and then 47K ASP across all models.
Yes. Something that I think some of the smart retail investors understand, but I think a lot of others maybe don't, is that every time we sell a car, it has the ability to have full self-driving enabled, and the full self-driving is obviously getting better very rapidly. That's actually a tremendous upside potential, because all of those cars, with a few exceptions, I mean, only a small percentage of cars don't have hardware 3. So that means that there's millions of cars where full self-driving can be sold at essentially 100% gross margin, and the value of FSD grows as the autonomous capability grows, and then when it becomes fully autonomous, that is a value increase in the fleet that might be the biggest asset value increase of anything in history.
Next, Tesla managed to further reduce their long-term debt all the way down to $1.6 billion, which is a great position to be in, especially if there's a global downturn. And with a reduction in debt, there also comes a reduction in interest payments, which helps boost profitability. On the other side of the equation, Tesla has increased their cash on hand to $22.2 billion, and the higher this number goes, the greater the chance we can see a potential stock buyback or dividends in the future. And in the final chart, Here is Tesla's interest income from operations, where Tesla received $157 million in interest, and yes, this number is quite small in the grand scheme of things, but it'll be interesting to see where this number goes if Tesla further continues to increase their cash on hand.
If we see a severe recession this year, which, like I said, hopefully we don't, in severe recessions, cash is king big time because it's in such short supply. So we want to be cautious about using cash for loans and that sort of thing for cars. I feel we're in a very strong position to get through a recession because we really don't have any debt and we've got over $20 billion of cash, which is great. The cash is earning a ridiculous return, not a good return. So it's like non-trivial. The interest rate is actually means the 20 billion is earning like quite a good amount.
So in summary, Q4 was a record quarter for revenue and net income, while the drop in Tesla's stock price has compressed the price to sales and price to earning ratios. Gross automotive margins and average selling prices did go lower due to the price cuts, while cash on hand is at record highs, while long-term debt is almost all but paid off, putting Tesla in a very strong position with global economic uncertainties. Finally, when I cover Q1 earnings, hopefully I'll be able to expand this episode to cover some more aspects of Tesla's business. But till then, have a great day and I'll see you in the next episode.